I think Bitcoin fundamentally solves the problem because it creates a whole new ledger that is actually at the root about as decentralized as we can make it. There's still, there's like supply chain concentrations to maybe kind of try to make a little bit better. There's still a handful of kind of attack points that are maybe not 100% decentralized, but it's so far it's the most decentralized thing I've seen.
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discuss about Bitcoin. Lyn Alden believed that Bitcoin essentially resolves the issue since it establishes a brand new ledger, which is the underlying source of the issue. Despite efforts to make the system as decentralized as possible, supply chain concentrations nevertheless exist. Attempts are being made to improve things a little bit, but there are still a few attack sites that, while perhaps not entirely decentralized, are now the most decentralized thing I've seen. And Lyn Alden believe that's our best opportunity right now. Other stable coins have a similar function in that they allow you to determine whether you're in Argentina or more. Generally, that there's not much the Argentinian government can do to stop stable coins from entering and leaving your nation. Now, if the US decided for whatever reason that they no longer liked stable coins, they could go after them. However, neither Nigeria nor Argentina can, hence for the citizens of those nations. The idea that a central hub exists, but that hub is independent of them and has the ability to sort of pierce in there. The primary function of these technologies is peer-to-peer sharing. With all these tiny 160 distinct currency bubbles actually only exist in two forms: physical ports of entry, which are tightly monitored of course, and you can only carry a lot of cash or gold through an airport, and wire transfers basically. Other kinds of bank transfers or fintech overlays would be the other, which are still essentially bank transfers, and which are also subject to strict government regulation, while Bitcoin stablecoins have comparable asset classes, and lots of things Lyn Alden discuss. So please watch the video to end, and like, share, subscribe our channel, Everyday Finance. Thanks.
So there's nothing on my horizon that really stands out other than Bitcoin. Specifically, you'd have, the blockchain combined with having the most decentralized type of it. So small nodes, proof of work, that seems to be the most robust way to do it. And then also, when you have the network effects, the liquidity, your network's now big enough to kind of stand up to pretty challenging attacks. Anything that so far that kind of uses other methods has a central hub, and that central hub is attackable. And so some of the examples I use in the book is like, there is a firm that people could have accounts denominated in gold ounces, for example, or gold grams actually. And you could just easily trade them around and you could do all this. And then the government just kind of shut them down. And of course, we've had some emerge since then. But really it's a chain of credit. And so it's not fundamentally solving the problem. I think Bitcoin fundamentally solves the problem because it creates a whole new ledger that is actually at the root about as decentralized as we can make it. There's still, there's like supply chain concentrations to maybe kind of try to make a little bit better. There's still a handful of kind of attack points that are maybe not 100% decentralized, but so far it's the most decentralized thing I've seen, and I think that's the best shot we have. Now, in other countries, I think stablecoins are serving a similar purpose, which is that, if you're in Argentina, or basically if you're the Argentinian government, there's very little you can do about stablecoins getting in and out of your country. Now, the United States could go after stablecoins if for some reason they decided they didn't like them anymore, but Argentina can't, or Nigeria can't. And so for people in those countries, the fact that there's a central hub, but that hub is outside of their jurisdiction, and it's able to kind of pierce in there peer-to-peer, that's the main thing that these technologies do, is that with all these little 160 different currency bubbles, really the only two ways to bring money in or out are physical ports of entry, which of course are heavily surveilled and you can only bring so much cash or gold through an airport. And the other one would be wire transfers, basically various types of bank transfers, or fintech overlays, which are still just essentially bank transfers. And those are also heavily controlled by government regulation. Whereas Bitcoin, stablecoins, similar types of assets, you can show a QR code on a video call and send money. You can send someone an email with money. You can DM with money. So as long as they're not shut off from the world like North Korea, you can send money in and out. You can memorize 12 words and just bring any amount of value density through an airport. And so that's just a world that technology exists now. And the ones that have central hubs can pierce into most countries. And if you're going to go after the biggest markets of all, I think you have to be decentralized at the root, which is, Bitcoin is the closest thing we have.
Global liquidity is the price activity of Bitcoin. And so, for instance, if Lyn Alden look at the global-wide money supply, which is expressed in dollars, there are two main parts to it. The first is the rate at which expansion of the money supply, particularly when it comes to the top 10 currencies, and how powerful the dollar is in comparison to them. That's the unit of account used to represent a lot of worldwide debt. It's similar to your obligation when the value of the dollar is declining or when money is printed on demand. Global liquidity is a statistic that increases significantly, and Bitcoin is typically highly connected with something to the benefit of the drawback. You can see that it's debatably true if you examine it in absolute terms or rate of change terms, greater correlation than the eyes. Having said that, Lyn Alden believe that helps as well. But in general, it's one of those strongly connected items and the majority of risk assets generally, such as our definition of a risk asset, which is a volatile asset. The majority of capital allocators would handle it in a correlated manner, having fluidity, however. As of right now, Bitcoin appears to be more closely associated with liquidity, which makes sense given that it's decoupled from other elements, such as earnings and other similar things. Essentially come into play when you're choosing whether or not to possess this rare new currency.
I think both are true. And the way I would describe it first is that, so the closest correlate I have found to Bitcoin price action is global liquidity. And so, for example, if I take global broad money supply denominated in dollars, which means there's two big components of it. One is how fast our money supply is expansion, especially the top 10 monies. And then two, how strong is the dollar relative, which is really important because that's what a lot of global debt is denominated in. That's like your liability unit of account. When the dollar is weakening or when the money printers are on, global liquidity, that global liquidity metric goes up quite a bit. And Bitcoin tends to be very correlated with that, to the upside, the downside. If you look at it in absolute terms or rate of change terms, you'll see it's arguably more correlated than the halving is, although the halving helps too, I think. But basically, it's one of those highly correlated things. And most risk assets in general, and I would define risk asset as volatile asset. That's how most capital kind of allocators would treat it. Most of those are correlated with liquidity. But so far, Bitcoin seems to be more correlated with liquidity, which I think makes sense because it's stripped away from other factors like earnings and things like that. It's basically when you're deciding whether or not you want to own this scarce emerging money, expansion of the broad money supply globally tends to be fuel for that. And if you have contractions or stagnations in that, usually people are not pouring into Bitcoin and they're more defensive elsewhere. So I think some of it is like literally just that. Bitcoin kind of bottomed when liquidity bottomed and has been rising with kind of like, we're not really in a booming liquidity environment right now, but we're not as bad as it was in, say, late 2022. But the other factor is, like, I talked to some bank board of directors or institutional allocators, and there is a changing of the view. Like when I talk about things like fiscal dominance or the risk of a fiscal spiral or things like that, or talking about structurally higher inflation for a period of time. Things that might have gotten you called a kook, 4 years ago, instead of the board of directors like scoffing when you're saying this, they're all kind of nodding along, like, yeah, that makes sense. Basically, it's slowly becoming kind of more aware that we are in kind of unusual times, and so I think that basically people are taking things like Bitcoin, gold, hard assets in general more seriously than they would have a few years ago. And every time, kind of the way that I've described it before is that people in the Bitcoin space, most people have seen like the log price chart of Bitcoin at this point, and they see it, it's got like 4 cycles to it. Most people have actually not seen that chart. And if they've seen the chart, they kind of dismiss it. What I think matters for people is not how many times Bitcoin's risen from the ashes, it's how many times they've seen it rise from the ashes. Because if they see a Bitcoin boom and it captures their attention for the first time, and then they see it crash, their view was, okay, this is exciting, oh, it's dead. If they see it come back a second time, That's when a lot of people have that like wake up moment. They're like, wait a second, that's actually a thing. And for some people, maybe it takes a third time, not of Bitcoin having that cycle, but them literally seeing that cycle. And I think that it's kind of getting to the point where, especially after the 2017 bull market, that was big enough that it got on a lot of people's radars. Obviously, the 2021 one got even on more people's radars. And if they start to see a sign that it might have another one, that maybe this thing isn't dead after all, like they might have written it off as, people start to actually take it more seriously. And I think that's around, at least around the margins. I think that's what we're seeing.